In the high-stakes world of pharmaceuticals, where innovation often means the difference between blockbuster success and complete failure, two companies stand out as global leaders, Eli Lilly and Novo Nordisk. But a closer look at these industry titans reveals a fascinating contrast in their approaches to capital allocation, offering a compelling case study in strategic decision-making. To understand their contrasting capital deployment philosophies, let's dissect three key metrics: net sales, R&D spending, and capital return to shareholders. By examining these, we'll gain insight into how each company is positioning itself for the future. At the heart of the matter is a fundamental choice: invest in building future pipelines and growth opportunities, or return capital to shareholders today. Let's start by looking at R&D intensity, which measures the percentage of a company's net sales that it invests back into research and development. For Eli Lilly, this metric has remained consistently high, hovering around 25% from 2018 to 2024. Novo Nordisk, on the other hand, has maintained a significantly lower R&D intensity, averaging only 13% during the same period. This stark contrast suggests that Lilly is making a conscious choice to double down on future innovation, whereas Novo Nordisk is taking a more measured, conservative approach to reinvesting in its own growth. Now let's turn our attention to shareholder returns, which encompass both dividends and stock buybacks. The percentage of net sales allocated to shareholders also tells an interesting story. Novo Nordisk has consistently returned twice as much capital to shareholders compared to Lilly over the past 5 years. This indicates that Novo is prioritizing the distribution of profits to investors in the near term, signaling a high degree of confidence in its existing business model and a limited willingness to make big bets on future growth. In essence, we're seeing a clear trade-off emerge. Novo Nordisk is rewarding shareholders handsomely today based on its current operations, while Eli Lilly is choosing to invest heavily in research with the expectation of reaping the benefits in the future. Of course, both companies operate in a highly competitive and constantly evolving industry. Novo Nordisk's blockbuster drug, Ozempic, for instance, faces generic competition from 2026, which may impact its future revenue streams. How the company navigates this challenge will be crucial to its continued success. In conclusion, the contrasting capital allocation strategies of Eli Lilly and Novo Nordisk offer a fascinating study in pharmaceutical business strategy. Novo Nordisk's focus on near-term rewards and operational efficiency may appeal to investors seeking stability and consistent returns, particularly in uncertain market conditions. Eli Lilly's heavy R&D investment, on the other hand, positions the company for potential breakthroughs and future growth, but also exposes it to the risks inherent in a highly innovative, highly competitive industry. Only time will tell which approach will lead to greater long-term success. But the strategic trade-off these companies are making is a valuable lesson for all. Balancing short-term pressures with long-term strategic goals is a constant tightrope walk for any company. And the path they choose can significantly impact not only their future, but the future of their industry.